Hello everyone, this is part 3 of my DR-IDR model. If you haven't watched the first and the second video, I highly recommend you to do so. Today I'm going to give you the last DR-IDR session, and with this one we finish the intraday cycle of DR-IDR time ranges. Why is he saying intraday? Are there higher time frames DR2? In between the regular DR from 9:30 to 10:30 am and the overnight DR from 3 to 4 am in the morning, we will add the after session DR from 7:30 to 8:30 pm New York local time. So the ADR or after session DR forms from 7:30 until 8:30 pm and stays valid until 2 am. As usual, all timings related to DR and IDR are New York local time. With valid, I refer to the rule set which is connected to every DR during the day. As this question came up so many times, I want to answer it. The last candle of the DR in TradingView is 5 minutes before the DR range ends. TradingView uses the opening of a candle for its timestamp. It means the last candle opens at 8:25 and closes at 8:30 in a 5-minute time frame, which is the only time frame that is relevant for DR levels and confirmations. So as usual, we take the high and the low inside the DR range, and we will have our ADR high and our IDR low. We take the highest and the lowest body close or open, and we have our AIDR high and our AIDR low. That also gives us the ADR range and the AIDR range. Now we can add our rule set. Close above ADR high confirms that price will not close below ADR low with 88% probability for the ADR session and vice versa. Close above the AIDR high will give an early indication that price wants to extend to the upside and the other way around. Finally, let's add the open and the close of the ADR, and we have all important levels. To make it easy for everyone, we published a Pine script for TradingView, which does all the marking and levels for each DR session. The link for the script is in the description below, or you simply search for DR/IDR version 1 from the master on TradingView. Once you edit the script to your chart, it will look like this, and you will have all 3 DR sessions marked with all the respective levels. Please make sure you leave all the time settings on standard settings, and you will be able to use it with any instrument you would like to use it. So from now on, we are only talking about ADR, after session DR, ODR, overnight DR, and RDR, regular DR. Also in terms of DR intraday cycles, the day starts with the ADR followed by the ODR and finishes with the RDR. Let's talk about another question that was asked many times. Does your DR model work with Forex, crypto, etc.? The answer is yes, it does. It works with Forex. Here are some examples of Euro USD and USD Japanese Yen. If you look at the right corner of the screen, the gray box, you will find the statistics for these instruments. It works for cryptos like Bitcoin and Ethereum, with a slightly lower probability than the other assets. Gold, crude oil, coffee, and any other commodity. Not to mention it also works for stocks. The probability slightly varies between the different assets and the different DR sessions, but it is above 80% on average without considering high impact news. As usual, if you like the video, subscribe and leave a like and turn on the notification bell so you don't miss updates for my DR-IDR concept. I also opened a Discord server for everything which is DR related. You will find the link in the description below. Let's crunch some numbers, shall we? Let's take the Excel numbers and transform them into a good looking page. If I wouldn't know the DR model, what would be my key takeaways from looking at these numbers? First of all, I would understand that the DR-IDR model is not questionable. Proven by math and statistics over 12 years, having a bias that is not aligned with the DR has a very low chance to be successful. Sure, you can have some lucky sessions, but over the long term, trading against this data is way worse than going into the casino and playing roulette expecting you make a living out of it. As a matter of fact, it has higher probability than making money by trading against the DR bias. Next, I would figure that the DR-IDR gives me a clear edge in terms of in which ranges the price action will happen during the defined DR sessions. I would know where the safest stop-loss placement would be with a stunning high probability. I would know that the low-hanging fruit for my target placement would be based on the mean standard deviation numbers. Monday ODR false day stats would tell me that it almost only happens for short confirmations. That means long confirmations on Monday ODR sessions have a higher probability. Wednesday ODR and RDR stats show that long confirmations have the edge compared to all the other days, and long RDR confirmations have an edge of not being false. Wednesday is also the worst day for the RDR to be true. All across the board, the almost certain price target for all DR sessions is a standard deviation of 0.5 to the upside and downside. On false days, the down move in terms of standard deviation is always bigger than the upside. In general, Monday and Friday are having the highest probability for DR in any session to be true. That would be just a few of the key takeaways I would figure out at first look. I don't have to tell you that there is so much more hidden for you, and I want you to study these numbers and understand them. I really hope my thoughts made you curious to deep dive into this rabbit hole. So now that we have all three DR sessions, I want you to study the relationship between the ADR, ODR and RDR sessions as homework until the next video. I also urge you to pay attention to all ADR, ODR and RDR levels and how price is reacting to them during the trading day. To help you understand what I mean, I show you three models which happened during last week's trading. We start with the upside expansion model. As you can see, each DR session respected the previous DR high levels and created higher low DR levels and higher high DR levels. Also, price respected at any given point during the day the previous formed low DR levels and did not close below them. The second example I have for you is the so-called range expansion model. Each single DR extended the previous range of high and low DR levels, while the midpoint stayed within the IDR levels of the previous session. If the midpoint of the DR levels goes lower, it means we will see a range expansion with a slight downward trend and vice versa. Usually, price close to the mean of the total range or close to it. And the last example I have for you today is the downside expansion model. It follows the same logic as the upside expansion model, just to the downside. That's it from my side for today. I hope you enjoyed the video and you are on fire to study all the topics I explained to you today. We'll talk to you soon in DR IDR Part 4.